What's up traders, welcome back to my week 3 recap of the NASDAQ. In this video we're gonna talk about the importance of the economic calendar, especially looking at the CPI and PPI events, as well as a short excursus into the concept of power of 3. As we can see, price is trading inside a range still without creating FEGs and significant price runs. This overall means there is a big accumulation going on, and as usual we take a look at the economic calendar. We see we've had a lot of heavy hitters inside this week, namely the CPI, the PPI event, as well as the unemployment claims. Overall it's wise to avoid the newsless Monday, as well as the CPI day, the PPI day, and optimally also the unemployment claims day in the morning. Okay, let's take a look at the 1 hour chart here. We can see where CPI and PPI have happened. As a reminder, CPI is one of the big 3 news events that are heavily linked towards market manipulation. The market makers use this event to move the market as it provides a smokescreen, which essentially just means that they have a justification for extreme price movements. The other 2 big 3 events are FOMC and non-farm payroll, and we will take a look at the CPI event more in detail later. This is a short excursus into why January usually is a bad trading month and we shouldn't expect clear price action. The reason for this is the concept known as power of 3 or AMD. To set a foundation, every candle on every time frame can be defined in 3 steps, which are accumulation, manipulation, and distribution. As you can see, I marked out a candle here. It's a bullish case. Reverse it if you have a bearish case. And you could also say that this candle should look kinda like this if we look at the line chart. So the 3 stages I just talked about usually consist of an accumulation phase. This is where price is being held inside a range and liquidity is building up above the range and below the range. We then see a manipulation phase where one side of the marketplace or one liquidity is being raided. This gives smart money the opportunity to get into the position they desire at the best price possible by buying from willing sellers or selling from willing buyers using the stop loss of their trades. And lastly, we see the distribution phase. This is the phase where the actual price move is occurring and the real profit making part of the move is happening. Understanding this concept unlocks a real power, because not only candles but also sessions and years, so meaning the yearly candle, is formed around this premise. A key takeaway here is that we don't want to be part of the accumulation phase, as price is very spotty and hard to trade inside. Like I just said, the yearly candle is also formed under the premise of power of 3, and using this information I think it's clear to understand why January usually is not a good month. It's like trying to front run the market on what it actually wants to do. So be careful in January and part of February as well, and don't expect to see clear price action and easy obvious moves. To illustrate this concept a little bit more, this is the 2025 trading year on NASDAQ. Note that January and part of February is the accumulation phase. We then see a long manipulation phase that is lasting until April or May, followed then by the distribution phase of the year, which was seeking buy-side liquidity again made in January and February. And as we want to avoid the consolidation phase, we want to avoid most of January. This doesn't mean there are no moves that could be tradable in January. It just means that you have to dial back your expectations and be picky about your targets. Okay, back to CPI. Usually it is an untradable event, since brokers won't let you be filled into your positions or out of your positions. This means that your stop loss wouldn't even work, so it could result in a bigger drawdown than you set with your stop loss, potentially ruining your account or your funded challenge. So the best advice is just to stay put until all those events are over. It also highlights why the economic calendar is so important to know, so you can anticipate when those big 400 pip moves are gonna occur. For this chart I want you to notice how price consolidates before the CPI event, and also how unclear the price action is directly afterwards. This is because we have 2 more heavy hitters coming in the week, which brings us to the first one, which is PPI. We treat it the same way as we treat CPI. The only difference is that afterwards, price action will be a little bit more clearer. As you can see, around equities open at 9:30 New York local time. So there's a possibility to be active afterwards, but I prefer to also wait for the unemployment claims to happen, which is the example I brought you here. It's the PM session of Thursday, and as you can see, the patience is rewarded here. here with a low resistance liquidity run, meaning an easy price run to trade. And we see the usual things like a raid on buy side liquidity, then a break of market structure. We're trading to the bearish order block and the first presented fair value gap. We also then get a breakaway gap at roughly 50% of the move. Second stage distribution happens at the level of the sell side liquidity. We also retrade to the order block inside the second stage distribution. And finally, as it should, it is the strongest move pushing us even lower. So don't rush into the first half of the week trying to make all your profits. Stay calm and be selective about the setups you take. Alright, that's it for week 3 already. I hope I could reinforce the importance of the economic calendar, as well as the concept of power of 3 or AMD, which stands for accumulation, manipulation, distribution. Let me know if you want to learn more with a like on this video, and also let me know in the comments which concepts you struggle with and want me to explain more in detail. Subscribe to the channel to stay up to date, and with that being said, stay safe and healthy, good trading, and see you in the next video.